So now we'll write down one question on jointly controlled operation. This question is from a reference book. You will have to note down in the notebook. This question is not printed. Following is the trial balance of Monty Limited on 31st March 2013 is given below. So this is the trial balance, not a balance sheet. Write down, following is the trial balance of Monty Limited on 31st March 2013 is given below. Draw this trial balance: debit balance rupees in lakhs, credit balance rupees in lakhs. Then write down on the debit side, opening stock 160, purchases 1040, expenses 150, depreciation 70, fixed asset 630, debtors 250, bank 100, total 2400. Credit balance side, write down fast: sales 1300, share capital 1000 in bracket of rupees 10 each, share capital rupees 10, profit and loss account 31st March 12, 80, suspense account 20, total 2400. During the year 2012-13, Monty Limited entered into joint venture with Ponty. Monty Limited entered into joint venture with Ponty Limited to buy and sell used machine. The profit and losses of the ventures are to be shared equally. The profit and losses of the ventures are to be shared equally. Equally underline the balance of suspense account. So this suspense account, there is a note on that. The balance of suspense account represents transaction of Monty Limited for the ventures as per details given below. Now these are the transactions entered into by Monty Limited with respect to joint venture. Right hand side, draw two columns: rupees in lakhs. Very important question. You will not find this question in study material or in other class notes also. It is only in your class. Okay. Sold 16 machines for the venture at rupees 5 lakh. Sold 16 machine for the venture at 5 lakh, right? 80 lakh. Purchased 14 machines for the venture at rupees 4 lakh, 56 lakh, 14 into 4. Expense incurred on behalf of JV expense incurred on behalf of JV 4 lakh, expense incurred on behalf of JV 4 lakh, and then balance of suspense account 20, balance of suspense account 20, 80 is the amount received from sale, 50 is the amount paid for purchase, 4 is the expense incurred. So therefore this is the balance, and what this accountant has done, he has transferred this balance to suspense account, and now it is appearing in the trial balance. The net effect of this joint venture transaction, he has transferred to an account called suspense account. So we will have to eliminate the suspense account. Up to this you have noted. Now write down below, continue 5 more points, then we'll write the answer. Ponti Limited, Ponti is another venturer. Ponti Limited purchased 18 machines at rupees 4 lakh per machine, and sold 10 machines at rupees 5 lakh, and sold 10 machines at rupees 5 lakh. Expenses incurred on behalf of JV, expenses incurred on behalf of JV expenses incurred on behalf of JV 6 lakh. Expenses incurred on behalf of JV 6 lakh. Third point, write down value of closing stock of Monty Limited. Value of closing stock of Monty Limited, excluding the stock of JV, was rupees 168 lakh. This is the closing stock of Monty excluding the stock of JV. Then point 4, write down prepare profit and loss account for the year ended 31st March 2013 and its balance sheet on that date, as on that date. This is the question on jointly controlled operation. If Monty Limited has a subsidiary, write down. If Monty Limited has a subsidiary company, then what additional or special entries are required to pass for CFS? What additional or special entries are required to pass for CFS? CFS means consolidated financial statement. So if it is a JCO, whatever figures we have used in separate financial statement, the same figure will get transferred to jointly controlled, same figure will transfer to CFS also. So let us read the problem again. Hopefully you have written. If you are not able to write, stop the video for a second and then you can copy whatever you want to write. This is one of the very important questions of this topic for understanding and for exam purpose. So the question I will read, following is the trial balance for the year ended 31st March 2013 of Monty Limited. then a trial balance is given which shows the transactions of Monty Limited and transactions relating to joint venture has been shown as suspense account. During the year, they have entered into joint venture with Ponty Limited to buy and sell used machine. Profit and losses will be shared equally. The balance in suspense account for the venture was as per given below. So these are the details of the transaction which Monty Limited has entered into on behalf of joint venture, and the other venturer Ponty Limited has also purchased 18 machine at rupees 4 lakh per machine. He has sold 10 machine at rupees 5 lakh. Expenses incurred by Ponty Limited on behalf of JV is 6 lakh. Closing stock of Monty other than the stock of JV was 168 lakh. Prepare P&L account and balance sheet, and whether you are going to pass any additional entry for CFS. We have to do the accounting in the books of Monty, M-O-N-T-Y. Monty will record his share in revenue, his share in purchase, his share in expense, and his share in the stock relating to venture. Now the student will understand Monty, Ponty, together they have made sales of, this fellow has sold 80, Ponty has sold 10 machines at 5 lakh, 10 into 550. So total sales of the joint venture is 130. Purchase, understand, then we'll write the answer nicely. Monty has purchased 56 lakh, Ponty has purchased 18 into 4, 72 lakh. So total purchase made by them 56 plus 72, 128. Total expense, Monty has incurred 4, Ponty has incurred 6, total 10. And now let us also look at the closing stock. What will be the closing stock? Total purchase made by them is 14 units purchased by Monty, and Ponty has purchased 18. This is purchase, and total sale is 16 unit by Monty and 10 units by Ponty. So closing stock will be 32 purchased, 26 sold. So closing stock will be 6 units, and the rate is 4 lakh rupees. So that closing stock will be 24 lakhs. This is purchase, this is sale, this is closing stock quantity, and this is cost per unit. So they have closing stock of 24 lakh. Now what will be Monty's share? So they have agreed to share equally. So Monty's share would be 130 divided by 2. Monty would record a sale of 65. Monty would record a purchase of 64. And Monty would record expense of 5. And Monty would record closing stock of joint venture 12. So this sale, purchase, expense we are going to record in the books of Monty. We are going to eliminate suspense account of 20, and the balancing figure represents amount receivable or payable either from or to Ponty. Okay, so please now take out your notebook and write down the answer. In case if you are interested candidate, you can note down this kind of explanation provided to you, but otherwise not required. What you have to exactly write in the exam Now I am going to tell you. Okay. So this 12 lakh closing stock will be shown in Monty's book. Students will now write the answer. It is a case of JCO. Write down first, it is a case of JCO. Then write down, in the books of Monty. In the books of Monty. In the books of Monty, write down. First we'll do the calculation. Share of Monty Limited in joint venture purchase. Share of Monty Limited in joint venture purchase. Share your joint venture. Share of Monty Limited in joint venture purchase. 50% of total machines purchased by both venturer 14 plus 18, that is 32 machines, into 4 lakh. So the answer will come to 64 lakh. Please check. Share of Monty Limited in joint venture sale. Share of Monty Limited in joint venture sales. 50% into bracket 16 plus 10, that is 26 machines, into 5 lakh, that is 65 lakh. Then write down share of Monty Limited in joint venture expense. Share of Monty Limited in joint venture expense. 50% of 4 lakh plus 6 lakh. 50% of 4 lakh plus 6 lakh. Total expense is 10 lakh. Each of them will share 50%. So that is 5 lakh. And one more, share of Monty Limited in joint venture stock. Share of Monty Limited in joint venture stock. Joint venture stock, you can see here 32 machines were purchased, 26 machines were sold. So we are left with 6 machines whose cost is 4 lakh. Total value 24 lakh. Monty's share 50%. So Monty would record in its book closing stock of 12 lakh. Closing stock of 12 lakh. Is it right? Now the question is, what entry Monty Limited would pass in its book for recording transactions relating to jointly controlled operation. So they are going to record purchase, sale, expense. They are going to eliminate suspense account. Any difference is receivable or payable to the other venturer. Please write down adjusting entry in the books of Monty. Adjusting entry in the books of Monty. Please write purchases account debit 64 lakh. Expense account debit 5 lakh. Expense account debit 5 lakh. We are going to eliminate the suspense account. The suspense account has a credit balance of 20. Now you debit it. If you debit suspense account 20, suspense account will close. And then you record sale relating to joint venture to sale 65 lakh. And the balancing figure is amount payable to Monty Limited 24 lakh. Amount payable to Monty Limited 24 lakh. The net amount payable to Monty Limited is 24 lakhs, right? Automatically what will happen? You are going to record purchase, expense and sales. So adjustment will be in the profit and loss account. Automatically the net profit will get reflected in the profit and loss account. Plus of course you are also going to record 12 lakh rupees of inventory. 12 lakh rupees of inventory in the profit and loss account. Ponty Limited will appear in the balance sheet as a current liability. This is the amount payable to Ponty Limited. This is the amount payable to Ponty Limited. Now write one note below. Total value of closing stock. Total value of closing stock of Monty. Total value of closing stock of Monty. Total value of closing stock of Monty. Monty Limited own stock given in the problem 168 lakh plus Monty Limited share in the asset of the joint venture 12 lakh, and therefore Monty Limited will present closing stock of 180 lakhs. Now in addition to this, we have to prepare P&L account and balance sheet. Now you will look at the trial balance which is given to you. Open your notebook fully, and in the trial balance identify the item which will go to P&L account. So one item is sales on the credit side. On the debit side we have opening stock, purchase, expense, depreciation. So these are the items which will be written in P&L account, and we are going to add 64 lakh rupees in the purchase, we are going to add 5 lakh in expense, and we are going to add 65 lakh in the sales figure, and we are going to adjust closing stock also in the trial balance in the P&L account. Okay, so let us write down profit and loss account for the year ended, profit and loss statement for the year ended 31st March 2013. Profit and loss statement for the year ended 31st March 2013. Keep the trial balance in front of you. On the credit side we have sales 1300 and plus share in sales of joint venture 65. So my total sale that will appear in P&L account is 1365. 1300 sales made by Monty directly, and 65 is the share in the revenue, in the income from the joint venture. Now write down below less expenditure. Under that purchase cost of goods. If you look at the trial balance debit side, second line we have 1040 and 64 is the share in purchase of joint venture. So total purchase in bracket 1104. Then change in inventory. Our closing stock is 180 and opening stock is given in trial balance first line debit side 160. So change in inventory 20. Change in inventory 20. Is it right? The net effect of these two items is called cost of goods sold. The net effect of these two items is cost of goods sold. But we have to present separately. Then write down depreciation. In the books of Monty trial balance fourth line 70, there is no depreciation in venture, joint venture. So 70 in bracket. Other expense in the trial balance of Monty third line 150, share in joint venture expense 5, total expense 155. Total expense 155. Therefore net profit, take your calculator, type 1365 minus 1104 plus 20 minus 70 minus 155 is equal to 56. So this 56 we are going to transfer to the balance sheet. In balance sheet we have to add 56 to the opening balance of P&L account. Now again look at the trial balance. Which item will be shown in balance sheet? Credit side, share capital, P&L account. In P&L account I am going to add 56, plus I have to also write current liability amount payable to Ponti Limited, which we had calculated in the journal entry 24 lakh. Then on the debit side we are going to write items like fixed asset, debtor, bank and closing stock on the asset side. Fixed asset, debtors, bank, closing stock. Fixed asset will be shown in property, plant, equipment. Debtors and bank and closing stock will come in current asset. So that is how you will prepare the balance sheet. Very good question. Please write consolidated balance sheet of Monty Limited on 31/3/2013. Consolidated balance sheet of Monty Limited as on 31st March 2013. Balance sheet preferably should be in Schedule 3 format. Okay, write point 1. Write point 1. Equity and liabilities. Shareholder fund. Under shareholder fund write down A share capital. A share capital. Share capital will remain same 1000. Then write down B reserve and surplus. Reserve and surplus, P&L account you will see opening balance 80 in the trial balance plus 56 profit from for this year, 56 profit for this year. So total profit is 136. Total profit is 136. Then we have amount payable to Ponti Limited. So that will come in current liability, Ponti Limited 24. Take the total. Take the total 1160. Liability side total, please check 1160. Come to part 2 asset side. Write one non-current asset. Under that write property, plant, equipment. Trial balance, debit balance side, last third line. You have 630. Depreciation is already charged because depreciation is appearing in the trial balance. So depreciation is already deducted while calculating 630. Then point number 2 write down current asset. Under current asset write inventory 180, closing stock 180. Already we have discussed 168 plus 12. Trade receivable. Trade receivable from the trial balance, debtor 250. Point C bank. You can write cash and cash equivalent. 100. Cash and cash equivalent 100, and therefore the total is 1160. Therefore the total is 1160. This is how the balance sheet will be prepared, and you will write a note. Your question is, will there be any special or adjustment entry required in CFS? The answer is no. The same balances which we have written in this separate financial statement, the same balance will be used in preparing consolidated balance sheet also. So if it is a JCO, no special treatment is required. So please write down a note. This note is printed below in blue font. That is also a part of the last answer. Note, write down once Monty Limited merges the transaction of joint venture with its own business, then there is no need to pass any separate entries for CFS there is no need to pass any separate entries for CFS with group accounts subsequently applicable to JCO. There is no need to pass any separate entry for CFS with group accounts subsequently applicable to JCO. You can just write down there is no need to pass any special entry in CFS. There is no need to pass any special entry in CFS, and that will be enough. So that was a question from a very good reference book that will help you to understand the concept of jointly controlled operation. This is an example of jointly controlled operation, how the accounting is done in the books of a venturer. You will record your share in revenue, which we did, expense, asset, okay, and whatever are your own asset and liabilities, they will continue in your books. One question will take from the institute side also. Question number 12, after some pages, come to question number 12 towards the end of the chapter. Keep turning the pages till you reach question number 12, and that is from your study material of the institute. Okay, so I am going to solve in front of you this entire question, and you will concentrate on the understanding. If Mr. A, Mr. B and Mr. C entered into a joint venture to purchase a land, construct and sell flats. So this is an example of JCO. Their operation is to construct, purchase a land, construct and then sell the flats. No new entities created. No new entities created here. Mr. A purchased the land for 60 lakh. So A's duty is to go and buy land from the market on 1/1/2000, and for this purpose he took loan from a bank for rupees 50 lakh at 8% interest. Tick mark. So you will have to compute interest on 50 lakh at 8% per annum, and this activity started on 1st January 2001. He also paid registration fees of 60,000 on the same day. So these are the transactions of Mr. A. He purchased land for 60 lakh, but to purchase the land, the loan taken was 50 lakh. Mr. B supplied the material. Now what is Mr. B doing? He supplied the material for 4,50,000 from his own godown, and further he purchased the material of 5 lakh for the joint venture. So he has contributed material worth 9,50,000 for joint venture. And what about Mr. C? He made all other expenses of advertising, labor and other expenses, which is 9 lakh. So C incurred 9 lakh. Then on 30th June 2001, on 30th June 2001, dates are important for interest calculation. On 30th June 2001, each of the venture agreed to take away one flat to be valued at 10 lakh rupees each flat, and the rest were sold by them. So one flat will be taken by each of them, that is valued at 10 lakh, and then they sold the flats. A sold some flats for 40 lakh, B sold few flats for 20 lakh and C sold for 10 lakh. So this is what they sold. Loan was repaid on the same day by Mr. A along with interest. So how much interest they will pay? On 50 lakh at 8% for 6 months, that comes to 2 lakh. And the net proceed was shared by the partners equally. Net proceeds were shared by the partners equally. So whatever is the net profit will be shared by the partners equally. You are required to draft the consolidated P&L account. So you have to basically find out how much was the profit and loss on this joint venture activity. Although they have used the word consolidated P&L account, It means that you have to make a rough statement of profit and loss. It is not a part of my ledger system because there is no new entity formed. So the partners will just sit down and see how much profit they made on this deal, and joint venture account in the books of each venturer. Question taken from, I think, some 12th standard or foundation class, something which you must have already done at 12th standard or foundation level. So first I'll find out the profit and loss made by this joint venture. So whatever is written here, we are going to write all expense on the debit side, all revenue, all drawings on the credit side, and the balance is the profit. So the student can also write the answer if they are interested candidate, and if they are not, then it's okay. You can write in the notebook if you want, otherwise the answer is printed, but as a homework you must complete in the notebook without reading the answer, and that is your real test of understanding. Same problem I request you to solve in the notebook today. Before you go to sleep, solve question number 12, which is taken from your study material of the institute. How do you prepare P&L account? As usual, first we will start reading the problem and again start posting on the either debit or credit side. Mr. A purchased a land. So because the activity is to purchase land, construct flat and sell, all this will form part of your profit and loss statement. To purchase of land, to purchase of land, and who has purchased? You can write the name of the partner, A, 60 lakh. Then it says he took a loan from a bank, rupees 50 lakh at 8% interest per annum. So we have to also write to bank interest. Bank interest will be paid by Mr. A. Of course, it will be shared by all the partners. Why will Mr. A pay the interest? Every partner will share the interest, and the interest amount will be, write the calculation, 50 lakh into 8% into 6 by 12, that comes to 2 lakh. That comes to 2 lakh. Next line, Mr. B supplied the material. There is one more item. He also paid registration fees of rupees 60,000. To registration fees. To registration fees paid by Mr. A is 60,000. Then it says Mr. B supplied the material. To material, Mr. B supplied 4,50,000 from own godown, and 5 lakh he had to purchase from the market, 5 lakh. So total material cost 9,50,000. This is supplied by Mr. B. Then it says Mr. C made all expenses of advertising, labor and other incidental expense. So two other expenses paid by Mr. C, and this amounted to rupees 9 lakh. Now it says on 30th June each of the venturer agreed to take away one flat to be valued at 10 lakh each. So you will write by flats taken away by venturers. By flats taken away by venturers. Under that we have 3 venturer, A, B, C. Each of them took away one flat valued at rupees 10 lakh. So total is 30 lakh, and then there is a sale also, by sale of flats. 3 venturers have sold flats. Whosoever could find the customer, A was able to sell flats for 40 lakh, B was able to sell for 10 lakh, C was able to sell for 10 lakh. So total sale proceed 70 lakh. Now these are the transactions given in the problem. So we are going to find out the profit, and this profit will be shared equally. So on your calculator, take on the credit side we have 70 lakh plus 30 lakh minus debit side 60 lakh minus 2 lakh minus 60,000 minus 9,50,000 minus 9 lakh, and that is coming to 18 lakh 90,000 profit. 18 lakh 90,000 divided by 3. So each venturer is entitled to 6,30,000 rupees of profit. Very simple. Just read the problem, post it in the draft P&L account. So that is my first answer. Now the next question is, prepare joint venture account in the books of each venturer. So we'll prepare books of A, joint venture account. Whatever transaction they have entered into with respect to joint venture, they are going to record it. So first you draw the 3 format. Books of B, joint venture account. So you just have to record transactions relating to joint venture. You must have done this in your 12th standard classes or foundation course. Any other presentation is okay as long as your answer is correct. Joint venture account in the books of C. So let us start. We'll again read the problem and first post it now in the books of Mr. A, joint venture account. It says Mr. A purchased a land for 60 lakh on 1120x1, and for the purpose he took a bank loan for rupees 60 lakh. So he will write in the books of A, to bank loan. He has taken a bank loan for the purpose of purchase of land 50 lakh, and he has paid from his own pocket also 10 lakh. This is 60 lakh minus 50 lakh loan. 60 lakh minus 50 lakh loan. Then he paid interest to bank interest. To bank account, in bracket bank interest. To bank account in bracket bank interest 2 lakh. Then he paid registration fees also to bank account. Registration fees he paid 60,000. So follow the problem, and his share in the profit of joint venture is 6,30,000. So to profit on joint venture, this will be transferred to joint venture. This will be transferred to P&L account 6,30,000. These are the transactions entered by Mr. A, plus there are 2 more transactions he has sold flats by bank, sale of flat, and he got 40 lakh. Then he acquired one flat, so he will write buy land and building. So in his book, land and building account will appear at rupees 10 lakh. Now let us wait for completion part. It is not telling. Whatever is the difference, he will receive or he has to pay to other venturers. Let us look at the question from B's point of view. B has incurred two expenses. One is he supplied material from his own resources, so his purchase account will be credited. When he purchased the material, his purchase was debited. Now he is supplying for joint venture, so purchases will be reduced to that extent. It is not paid out of bank, it is paid out of existing stock, so purchase will be reduced, and to bank will write 5 lakh for material purchased for joint venture, and to profit on joint venture will write his share 6 lakh 30,000. He has sold flat by bank, he has sold flat and he collected 20 lakh rupees, and by land and building he has taken over one flat valued at 10 lakh. And now we'll write entries in the books of C also. C has incurred expenses on behalf of the joint venture to bank 9 lakh expenses incurred, and to profit on JV his share in the profit is 6 lakh 30,000. Now we'll see how to close. One more thing, write by sale of flats, write down 10 lakh, and by land and building one flat he has taken over for 10 lakh. Now first I'll close C's account. 20 lakh credit side total, debit side is 9 lakh and 6 lakh 13,000, 15 lakh 30,000. So 20 lakh minus 15 lakh 30,000, 4 lakh 70,000 is the difference. Is this difference payable to A or B? Let us wait. It has to be paid either to A or to B. So I'll first close B. B on the credit side is more, 30 lakh, and on the debit side it is less, so there must be some difference on the debit side. Let us find the difference in the books of B on debit side. So we have 30 lakh minus 4 lakh 50,000 minus 5 lakh and minus 6 lakh 30,000. So that comes to 14 lakh 20,000. So this both parties are going to pay to A. So to bank, write down in bracket paid to A. Here also to bank in bracket paid to A. Balancing figure. In the books of A, joint venture account on the credit side, by bank received from B, 1420,000 by bank received from C 4 lakh 70,000. This is how the accounts will be closed. Now just check whether A's account, whether joint venture account in the books of A is automatically tallying or not. If it is automatically tallying, then my job is done. So the total on the credit side I have taken is coming to 68,90,000, and then let me try on the debit side 50 plus 10, 60 plus 2, 62, 68,90,000 again, 68,90,000. So this is how you are going to prepare accounts when you are solving questions on jointly controlled operation. These are the two important questions I have done, one taken from study material and one taken from reference book. Now we'll come to another issue called jointly controlled asset. Please come back to your notes, theory part, paragraph number 8, jointly controlled assets. For example, a building will be jointly owned by two parties A and B. So they may jointly own, they may rent it out, and whatever rent will be received will be shared by A and B. Whatever maintenance will be incurred by maintenance and other expense, that will also be shared by these two parties as agreed. Okay, so accounting is very simple here. No new entity is formed. Each venturer is going to record his share of output or his share of expense in his separate financial statement, and the same amount will be transferred to consolidated financial statement. So this is one example of building. The other examples of jointly controlled asset could be oil pipeline. Oil pipelines are used to transfer oil and gas from one location to other, and it is jointly owned by two or more companies, because if every company construct its own oil pipeline, it will be very expensive for them. Then as I gave you an example of a building or a property which is owned jointly by two or more parties and they share the income. Then two or more companies can jointly own aircraft also. Instead of each company investing a big amount on aircraft, they can jointly own the aircraft. What about the accounting treatment? The accounting treatment is similar to JCO. Accounting treatment is very similar to JCO. The venturer will first record in the separate financial statement, and then it will also record the same figure in the consolidated financial statement if the venturer is preparing consolidated financial statement. So no difference in the treatment in CFS or in SFS. So what you are going to do, you are going to record, suppose you are jointly owning an asset, you are going to record your share in that jointly owned asset, which you and the other party must have agreed, whether you own 40%, 50% or whatever amount you have agreed. Secondly, you will record in your book any liability or expense which it has incurred. In your book, whatever liability you have incurred, record in your book. Any expense which you have incurred, record in your book. You will record your share in jointly owned liabilities, jointly incurred liabilities. If liabilities were incurred commonly, jointly, then you will record your share of liability. Like for example, property tax payable, society maintenance charges payable, that parties will record according to the agreed ratio. And similarly, the common expenses relating to that jointly controlled asset, like maintenance of a building, okay, those will be again recorded in each venturer's book according to the ratio they have agreed. So in your own book you record your share of asset, your share in liability, your share in income, your share in expense, your share in output, and whatever assets and liabilities you own directly, those assets, those liabilities will of course come in your books. So venturer's share in asset, liability, expense and income is already recorded in the separate financial statement. Hence in CFS, underline, because that can be a question in the notes, that whether I need to make any special or additional adjustment in consolidated financial statement. The answer is, if it is a case of jointly controlled asset, we are not required to prepare any additional entry or special entry in CFS. One important thing about JCA, no new separate legal entities created. Okay, each party will record his transaction in his books. No new entities created. They might prepare a draft profit and loss statement for the purpose of calculating the profit from the joint venture, like we did in the earlier problem. One real life example we will take from jointly controlled asset. Gas pipeline connects 2 points between Mumbai and Pune. This is the story of two companies which are jointly owning a gas pipeline to be transported from Mumbai to Pune, which is having a distance of about 150 km. The two companies, which are the two venturers X and Y, are engaged in extraction, refining natural gas and making ready for use as cooking gas for household. Both the companies are located in Mumbai, but the customers are located in Pune. So now if they construct pipelines independently, each of them will have to construct their own pipeline, which is very expensive. So they decided to have jointly owned pipeline, and then they have agreed to the following terms and conditions. Gas pipeline is owned jointly along with equipment at loading and discharge point to measure loss in transit and volume of gas discharged. Gas produced by both is transported to Pune city. These are the terms and conditions, just for conceptual understanding, practical learning. In the exam they are not going to ask you all these details of the agreement. At Pune city it is bottled into cylinders and supplied to customers by the respective company. Ownership of the pipeline and equipment is jointly shared. X owns 30%, Y owns 70%. Ownership of gas transported through the pipeline is separate. Identifiable with reference to volume. X Limited will pay to Y Limited a sum of rupees 50 crore for sharing the facilities. The responsibility of operating the gas pipeline is with Y Limited. All expenses specified in the agreement, other than depreciation, will be shared in the ratio of cylinders bottled on a quarterly basis. Now this was a real life example of two companies which are owning gas pipeline, and this gas pipeline connects Mumbai to Pune. So they are able to cut down a lot of cost on investment in separate oil pipelines. You are not required to remember the details of the agreement. This is just for understanding. Okay, so the summary of our discussion is, each venturer will record his transaction in his books. Okay, no new entities created. Whatever you will record in SFS will get transferred to consolidated financial statement also. So I am going to dictate one question to you. I am going to dictate one question to you, and you will try it. You will try it. Okay. This question will give you a very good understanding of how to do accounting of jointly controlled asset. Question is not from the study material, from a reference book, but a good question for understanding purpose. So please write down the question. Question, write down in the notebook. Question is not printed. On 1/4/2012, Salvi Limited and Dalvi Limited, entered into a joint venture to purchase Volvo buses and to let out on rental basis. So that is their common asset, Volvo bus. So Volvo bus will be jointly owned by them. Bus will be rented out, they will share the rent. Second line, cost of the total fleet of assets. Amounted to rupees 100 lakh. Third point, stamp duty amounts to 2%. Stamp duty amounts to 2%. Salvi and Dalvi decided to record the jointly controlled asset in equal ratio. Underline, Salvi and Dalvi decided to record the jointly controlled asset in equal ratio. Fourth point, right, Salvi raised a loan of rupees 70 lakh. And balance cost was financed by Dalvi. At 12% per annum. Fifth point, right, yearly higher charges collections made by Salvi was rupees 9 lakh and Dalvi rupees 21 lakh. Expenses incurred. Salvi rupees 2 lakh and Dalvi rupees 5 lakh. Sharing of revenue and expenses is decided as 3:2 between Salvi and Dalvi. 3:2 between Salvi and Dalvi. For your further information, interest on loan was outstanding. They have taken in loan, so on that interest is outstanding and unpaid by the end of the year. Next line, life of the buses were estimated to be 10 years. Then write down, compute the profit or loss of each co-venturer. For the year for the year 2012-13, for the year 2012-13, then write down also pass journal entries, in the books of each venture, also pass journal entries in the books of each venture, also pass journal entries in the books of each venturer, Is it right? So first you write down total cost of all buses. Total cost of all buses will be 100 lakh plus 2% stamp duty, 102 lakhs. Total cost of all buses, write down 102 lakh. Second, write down loan taken by Dalvi. Total cost is 102 lakh. Salvi has taken a loan of 70 lakh. Therefore, Dalvi will take a loan of 32 lakhs. Dalvi will take a loan of rupees 32 lakhs. This is first point. Second point. Third point, write down total depreciation. Total depreciation, the life of the buses is 10 years. So 102 divided by 10 years, 10.2 lakhs. 10.2 lakhs. Total depreciation 10.2 lakhs. And one more point, write down for total interest. Total interest will be 102 lakhs is the loan amount, and the rate of interest is 12%. So the answer would be 12.24 lakhs. 12.24 lakhs. 12.24 lakhs. So once we are ready with this basic calculation, now I am going to prepare the statement showing profit of each venturer. Any query up to this? Very easy. Whatever I have written till now is very easy. Total cost of all buses including stamp duty, total loan taken by each venturer, total depreciation, total interest. Now we just have to allocate as per the agreement. Income will be shared in the ratio of 3:2. Expenditure will be shared in the ratio of 3:2. Depreciation they are going to share equally because they are going to record the jointly controlled asset equally. Loan interest on loan, they will record whatever loan they have individually taken. Interest on loan, they will record whatever loan they have individually taken. So Salvi will record interest on 70 lakh at 12%. Dalvi will record interest on loan on 32 lakh at 12%, assuming each of them have taken loan, okay, on their standalone, on their individual basis. So they are responsible for paying the interest themselves. Write down first statement of profit and loss. Statement of profit and loss on jointly controlled asset. Statement of profit and loss on jointly controlled asset, in bracket write rupees in lakhs. In bracket write rupees in lakhs. Draw this table. Particulars, total, ratio, Salvi Limited, Dalvi Limited. Then write down income. What is the total income? Total income is the total collections. The total collection made by these two parties are 9 lakh is collected by one venturer and 21 lakh is collected by the other venturer. So total 30. As per the agreement 3:2, Salvi should get 18, Dalvi should get 12. Now write down expenditure. Under that write down expenses. Expenses incurred by Salvi is 2 and Dalvi is 5. 2 plus 5. Total expenses incurred 7. Agreement says they will share the expenses in the ratio of 3:2. They will share the expenses in the ratio of 3:2. Okay. Salvi will get 4.2, Dalvi will get 2.8. Income we have shared 3:2, expense we have shared 3:2. Depreciation write down already calculated 10.2. Depreciation equal ratio because asset is owned equally, so 1:1. Depreciation 1:1 in the ratio of owning the asset, which is equal. So 10.2 divide 5.1, 5.1, and then interest. Total interest 12.24. Salvi will pay 70 lakh into 12%, 8.4. Dalvi will pay 32 lakh into 12%, that is 3.84. Each party will pay interest on the loan which they have taken themselves, 3.84. 3.84. Each party will pay interest on the loan that they have taken. Is it right? So my total profit of Salvi comes to 0.30 and total profit of Dalvi comes to 0.26. That is the net profit. 0.30, 0.26, total of the joint venture is 0.56. So each party is going to record his share in revenue, expense, depreciation, interest in his book. I have written one note, you also write down for removal of doubt. Interest in bracket write down read note. Read note below. Note write down interest is calculated in the ratio of loan. Interest is calculated in the ratio of loan and depreciation in the ratio of share of assets, and depreciation in the ratio of share of assets, and depreciation in the ratio of share of assets. So that is understandable. Now we'll pass entries. Write down journal in the books of co-venturer. Journal in the books of co-venturer. First write down books of Salvi Limited. Books of Salvi Limited. Books of Salvi Limited. How will Salvi Limited record in his books? You can pass separate entries or you can just pass one entry. Separate entry will help you to understand better. Total value of the asset is 102. Each party will record 50%. So you will write down asset account debit 51. How this 51 has come? 50% of 102. So you can write the calculation if you want. Then he has taken a loan. It has taken a loan of 70 to loan 70 and Dalvi Limited difference. Difference every time we will adjust in Dalvi Limited indicating receivable or payable. This is for purchase of asset and loan. Then you write down cash account debit 9. You have collected 9 directly. Salvi has collected 9 lakh rupees from the bus service business directly. So cash or bank account debit 9, but his share in income is 18. To income 18, and therefore Dalvi Limited account debit 9. Dalvi Limited account debit 9. Share of income recorded. Then similarly, share of expense. You can look at the above table. Share of expense is 4.2. So we are going to record 4.2, but we have paid only 2. So remaining amount will credit to Dalvi. Expense account debit 4.2 to cash account 2 to cash account 2 to Dalvi 2.2 balancing figure. Share of expense recorded. Then depreciation. Next entry is for depreciation. Depreciation account debit 5.1 to asset account 5.1. Depreciation account debit 5.1 to asset account 5.1. Depreciation charged. Your share only. Depreciation charge. And then we have to record interest, but interest was outstanding. So my entry will be interest account debit 8.4 to interest outstanding 8.4. Interest recognized. Being interest recognized. Being interest recognized. Being interest recognized. And now we are going to record in the books of Dalvi Limited same set of entries. Write down please. Books of Dalvi Limited. Books of Dalvi Limited. Books of Dalvi Limited. First entry, they will record their share in asset 51. Asset account debit 51. To loan account 32. To loan account 32. To Salvi Limited 19. To Salvi Limited 19. They have taken loan of 32, but asset recorded is 51. So to Salvi Limited 19. Then write down cash account debit 21. They have collected 21 from bus hire charges. Cash account debit 21. But their share of income is only 12. To income 12. To income 12. Collected 21, but share of income 12. To Salvi 9. To Salvi Limited 9. To Salvi Limited 9. Third entry, they have their share of expense is 2.8. Share of expense 2.8. But they have paid 5 from their pocket. Expense account debit 2.8. Salvi Limited account debit balancing figure 2.2. Okay. To cash or bank 5. To cash or bank 5. Share of expense recorded. Depreciation account debit to asset account. Fourth entry, depreciation account to asset account 5.1. And fifth entry, for interest, their interest accrued is 3.84. Interest account debit 3.84. To outstanding interest 3.84. To outstanding interest 3.84. This way you are going to record the entries in the books of the venturer in case of jointly controlled asset. This is a very good example for understanding, and the same figure will be reported in CFS also. Okay, same figures will get recorded in the CFS also. So today we'll stop here. We'll continue in the next lecture.